This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning, and the program aptly titled Dollars and Cents, where we help you make sense out of all of those different things that have anything and everything to do with your dollars, ranging from taxes to investments to retirement to Social Security to debt to mortgages to estate planning. The list could go on and on. We could take the whole hour listing all of the different topics that have anything to do with your dollars. But instead, we won't, thankfully, right? And we'll help you make sense out of some of the more pertinent issues that we've got on the table today. And, of course, as always, if you'd like to add your own issue to the table of conversation, fantastic. We certainly encourage that. To do that, it's a simple process. It just involves a phone and a finger, or doesn't even really need a finger. I guess you could speak it these days. 407-916-5400, toll free 1-866-916-5400, or you can send us an email. That email is my first name, Joel, Joel, at nelsonfinancialplanning.com. That's how you can get in touch with us. Much to talk about on the program today. We'll be covering the latest and greatest on the Secure Act. If you're familiar with a conversation we had on the program a month or so ago, maybe not quite a month ago, but it was more than last week ago. The Secure Act stands for Setting Every Community Up for Retirement Enhancement Act. Boy, I'll tell you, those folks in Washington, they spend a lot of time coming up with the titles of their bills these days. But it's referred to, if you take the acronym, Setting Every Community Up for Retirement Enhancement Act. That's where the secure part comes from. Interestingly, it deals with retirement and individual retirement accounts and the options that are available. Hence, they like to use the word secure with retirement. What is even more fascinating about that is how much the insurance industry had its hand in this legislation. So we're going to give you an update on what's the latest on that. It actually is kind of stalled a little bit, and also give you a little bit more of the background. When we talked about this about a month ago, we were very concerned that the insurance lobby may very well have preempted the entire process. And we've got some data and some numbers that will back that up. Leave it to the insurance lobby. Probably the insurance lobby was the one that came up with the secure title. Not sure. But some good stuff in that is that it raises the required minimum distribution age to 72. Some really bad stuff, though, I think more than offsets that. And we'll talk about that here on the program. We'll also talk about risks to retirement. There are many times where we think about the risks to our retirement is a declining market or a poor economy. In fact, studies show that that is not the primary risk to retirement. There are a couple of others that are much more powerful and much greater propensity to affect your retirement over the course of what hopefully for you is if you're retiring at 65 or 70, hopefully that's a good 20 or 25 years. So understanding those risks, of course, becomes pretty important. We'll tackle that on the program today. And then the importance of avoiding probate. My goodness, this one just kind of really sticks in my head on this, because it's just a whole bunch of money getting charged for not a whole lot of activity to do. So that's the key. Oh, of course, before we get into all of that, what happened this past week in the market? Relatively flat. Earnings season about halfway over. Hard to believe as calendar keeps rolling by on us. Earnings season for the second quarter is about halfway over. 44%, that's pretty close to half of the companies in the S&P 500 have reported their results. Good news, bad news, I think a little bit on that. 77%, that's a pretty good number, of those that have reported have delivered better than expected earnings. So that's good when you beat expectations. Problem is that those earnings are not as dramatic as they have been. The past couple of years, earnings were very, very strong in corporate America, particularly last year when you had the impact of the tax cuts come in. And so consequently, earnings are not as strong as they were a year ago, I think largely as a result of the big impact that those tax cuts had last year really increased the earnings. And so this year you don't have a similar occurrence happening, so you don't have the type of earnings growth that you did a year ago. Remember, anytime you hear these numbers getting tossed around in the media, growth or earnings growth or revenue growth or anything like that always refers to or compares to the number from a year ago, with some exceptions, but generally it's the number from a year ago. So what that means is that if I look at my earnings now and I compare them to where they were a year ago, well, a year ago they were getting a pretty nice bump in terms of the tax cuts, whereby this year you just don't have that. Looking ahead to this week, obviously more earnings will continue to come out for the second quarter. The big news for the coming week will, of course, be when the Federal Reserve meets. Widely expected that they will cut on Wednesday, which happens to be, my goodness, the last day of July already, coming up this Wednesday. Wednesday is when it is widely expected that the Federal Reserve will cut interest rates by 25 basis points, with an expectation that they may telegraph that they're going to do it again in September. Again, a few words of caution, which we voiced last week. Not sure that they need to go quite that far. Let's leave some stuff on the side in terms of economic tools so that if there is a dramatic event or a dramatic economic event, that they have some tools in the tool belt to still use. Although it seems to me, though, that they're definitely cutting it this coming Wednesday. Certainly that seems to be the entire message that they've been giving. So I think it would be very bad to sort of do an about face on that, given the public statements that have been made by members of the Federal Reserve. So look for that. I think it'll be a yawn by the market because the market has really priced all of that in. Widely expected that they're going to cut interest rates. The key thing is going to be what their comments are in about the next meeting coming up in September and whether they show their hand as to what they might do. Again, personally, not sure that it is necessary. The big issue that is weighing on them, I think, is that you've got a lot of other countries around the world that are literally running to this incredibly low to zero to, frankly, negative in terms of interest rates. And when you start to look at the numbers and how much they have shifted just this year, there was a total of $8 trillion in government debt around the world that had negative yields at year end. And negative yields is exactly as it sounds. We've talked about that also on a prior program this summer. And negative yields means that I put money away and I get less later on, even though it's sitting in a bond or some type of equivalent investment. I put money in, I get guaranteed to get less money when it's a negative yield on a bond. That doesn't sound like a very good investment to me, but yet there's a total of $8 trillion out of it at year end. And what the point of that is to try, you've got central banks all around the world that are trying to encourage spending behavior rather than people just sitting on money. Oftentimes, you don't have to worry about that in the U.S. because we're pretty much consumer driven. The rest of the world tries to encourage spending and is trying to do so by the use of negative yields. Here's the rest of the story. $8 trillion, we mentioned, was the amount of debt at negative yields at the end of the year. That's up to $13 trillion now. So there's been a bit of an increase as folks like the European Central Bank try to stave off signs of economic weakness in their economies. And so consequently, I think that amount of debt and that increase in debt that's at negative yields is one of those things that's really kind of forcing the Fed's hand a little bit. Because when you look at our economic data, it's pretty decent, but the rest of the world is trending very oppositely, and you just can't. It's hard to ignore that. Okay, in the global economy that we live in today, it's hard to ignore that when you see that big of a jump in sort of what everybody else is doing around the rest of the world, just driving yields low and into that negative territory. You've kind of got to follow the pack, if you will. You can't be it's hard to be the salmon swimming upstream, if you will, and raising rates while everybody else is cutting rates. And I think that has one of those things that's sort of caught up to the Fed a little bit, and why they feel the need to lower the rates a little bit next here on Wednesday. Hopefully they'll hold off on that in September. The economics here in this country are very unique versus when you look at other economies, Europe, Japan, and the like, and China to a certain extent. Massive demographic issues that are looming, along with a significant amount of promised government benefits that ultimately are with those demographic issues, meaning they've got much more older people than younger people working, paying into the system, older people retiring, not working, using the system. That's a bad equation, and you see that playing out in places in Europe and Japan, and to a certain extent in China. And so that's, I think, what is different about them versus us, where we don't have quite that same demographic issue that they have elsewhere. But the reality is that that's causing them to drive down, I think, or one of the factors that's causing them to drive down their yields as much as possible. So stay tuned on that. I'll tell you what, when you do the math, $13 trillion in negative yields, that's $1,700 for each person on Earth. So that's pretty significant, and an issue that I think we're going to continue to hear more and more of. What that means from an investment perspective, I'm not sure you want to be heavy on the bond side these days, that's for sure, because you're certainly not going to get much of a return on that side of the equation. Anyway, we will slide to the break. When we get back from the break, we will talk about the latest and greatest update on the Secure Act, and more importantly, the role of the powerful insurance lobby in that piece of legislation. When you hear it, it's going to probably disgust you a little bit, but we'll share it with you just so you know what all the inner workings are going on up in Washington. Here on Dollars and Cents, this is Joel Garris. Nelson Financial Planning, News Radio 93.1 WFLA.
iHeartRadio is the easy-to-use app for music and radio. Download the free iHeartRadio app today.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollar.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. This is your host, Joel Garris of Nelson Financial Planning. Those are some pretty powerful numbers about the increase in negative yielding government securities worldwide that we were talking about in that last segment. $8 trillion at the end of the year, now up to $13 trillion. My goodness, that is a tough environment, particularly if you have a heavy allocation on the bond side of things. The point of those negative yields, of course, after all, is to get people to get off the sidelines, spend money, or at least invest money. Doesn't seem to be working in parts of Europe, Japan, and China. So they keep trying, but unfortunately, it's not getting people off the sidelines. The good news is our economy here functions very differently from those. We're pretty much consumer driven. And when you look at the latest consumer numbers in this country, well, everybody's spending pretty well. So, but more on that, I'm sure, in the months and years ahead, because that will be a problem or an issue for many of those countries that doesn't just disappear overnight. That is for sure. Speaking of issues here in this country, well, we have to turn to Washington for that. There's a host of issues up there. But more importantly is the powerful role that lobbyists have in generating the legislation that then governs all of us. Now, that statement obviously is nothing new. We all know that that's sort of how the world works up in Washington. But when you start to peel back the layers of the onion and see just the impact that certain lobbies have, it really kind of sickens you quite a little bit. In particular, when you look at the role that the insurance lobby had in promoting the Secure Act, it's really unbelievable. So, for those of you who don't know, the Secure Act stands for Setting Every Community Up for Retirement Enhancement Act, or, okay, secure, because that's what the insurance industry offers, and so why not use that as a title? I mean, they could have just gone with that as a description, because after all, the insurance lobby had a tremendous amount of leeway in the writing of that legislation. Pros and cons on the Secure Act: raising the required minimum distribution age from 70.5 to 72. That's probably in the pro category, but the practicality of that is that most people, when they retire, they're drawing money out of their retirement accounts anyway to replace their income. So more often than not, for the most people, you're getting your required minimum distribution anyway. You're not putting that off till 70.5 or even 72. That's true probably for the most Americans out there, is that they're not sitting around at 70.5 saying, oh, I got to take my required minimum distribution out. No, they're taking it out as a supplement to their income already. So the push up to 72, it's fine. I'm not sure that that's as big of a pro as it's described. On the con side, the list is a little bit longer. First, on the con side of the Secure Act is the elimination of the stretch provision, which is a very powerful option that's available to your beneficiaries when you pass. This generation of folks that are in their 70s and 80s is really the first generation that's had any level of retirement assets, because they would still have been working and have had a number of years working when the transition happened in the private industry 30 years ago to go from a pension-based system to a retirement savings-based system. That's when the advent, the 401k, those types of vehicles were much more widespread. And so consequently, the generation of folks that is still with us, that has not yet passed away in droves, if you will, is sitting on a lot of retirement assets that are going to pass to the next generation. And the numbers suggest that it's going to be the largest wealth transfer in the history of the world. What that means, though, is that if you have the ability to stretch out that retirement account that you just inherited, then you don't have to pay the taxes all at one shot. What the Secure Act does is it says, oh, no, you're going to take that money and you're going to pay taxes on it along the way, and we're not going to let you extend it for more than a 10-year period of time. You know what that is? That's a way for the federal government to raise money. And if anything, I just don't like it when they do stuff to convince us that, oh, this is a good thing and we're being nice and we're being altruistic, when the reality is, when you start to look at the hard numbers, it's in fact a cash grab by the federal government, particularly with the elimination of the stretch IRA. What's even more of a con is on this legislation is the imprint that the insurance lobby had all over it. One of the chief provisions of the Secure Act is to make the annuity option a much more widespread, readily available option for the 401k marketplace. And that's where we have a little bit of a problem with how much that insurance lobby had in play for the act. Here's the numbers. During the period of there was three different lobbyists: the American Council of Life Insurers, the National Association of Insurance and Financial Advisors, and the Insured Retirement Institute. See, getting the drift here? Insurers, insurance, insured. Okay, the insurance lobby held a host of series of Capitol Hill lobbying days during the course of the first 2 weeks in May. They subsequently followed that up with a 15,000 letter campaign to lawmakers, plus a digital campaign that targeted Hill staffers. It's just amazing. Whereupon they said, okay, the insurance lobby had the gall to tell key legislators that it was ready to trigger the grassroots advocacy again. Folks, there's nothing grassroots about a digital campaign and 15,000 letters. It's not like you and I and your neighbor Joe next door are sitting down and writing letters to our congressman about this. 15,000 letters is the campaign that was put on by the insurance industry, plus a digital campaign. Okay, and then when there was hesitancy by key members of Congress, they were told, well, we're going to trigger our grassroots advocacy again. There's no grassroots. There's nothing grassroots about any of this stuff that's happening in Washington, particularly on this stuff. That plus a total of $5 million in political campaigns that one industry group, which one was it? It was the American something, ACLI, whatever that one is. Okay, one industry group gave $5 million alone. Folks, the solution to improve folks' retirement, and we understand, it's very clear when you look at the numbers, that there is absolutely a retirement crisis in this country. People have not saved enough for retirement. But new legislation, new options, new rules, changes aren't the answer. Because when you look at the options that are out there, there's plenty of options out there. It's about education, and it's about, this one's going to be hard, behavior. Changing behavior so that you save more for I know. It's as much as we want there to be some magic solution. And I think a lot of the folks in Washington live in some sort of magical land. I don't care what kind of legislation is passed to improve retirement savings for all Americans. It fundamentally comes down to changing behavior. Changing behavior. Spending less than what you bring in. You're never going to get it by legislating. It's crazy. But yet we have the Secure Act. We have states like California, okay, putting out their own savings plan, their IRAs. It's crazy. I'm going to make the argument that people don't know about an IRA. Okay, maybe. Not sure I agree with that, unless you've been living under a rock for the past 30 years, that there isn't some vehicle called an individual retirement account. And, okay, how do I open one? Well, there's this thing called Google. You put IRA in there. I'm pretty sure you'll have about 25 choices pop up on the first page. Click a button and figure it out. You can order stuff from Amazon, but you can't open up an IRA. I mean, come on. It's ridiculous. About education, fine. Okay, I guess you could spend some money that way. But this notion that we're going to roll out differences and changes and, we're going to legislate, and all of a sudden retirement savings is going to go up, not going to happen. And the solution, sure as heck, isn't it to cave into the insurance industry? Because out of all of the players in the financial services industry, and if you listen to this program on a regular basis, you know we're not a particularly big fan of some of the goings-on that happen in the financial services industry. But of all of the players in the financial services industry, the one that is subject to the least level of regulation is the insurance side of the financial services industry. And here we go. They are writing the legislation courtesy of their grassroots advocacy. Yeah. My neighbor Joe wrote a letter. No, he didn't. Okay. Insurance lobbyists wrote all those 15,000 letters. Anyway, that's the latest. We'll certainly keep you up to date on that. When we get back, we'll talk about the real risks to retirement here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. Was getting a little hot and bothered in that last segment. Matter of fact, I started breaking a little sweat out here, although probably it's Sunday morning, and, the folks at iHeartRadio save money. I don't think they run the air conditioning on Sunday morning, so they have me and my producer here and here just sweltering away. No, they actually do run the air, but I'm feeling all hot because of the conversation in the last segment. Boy, I'll tell you what, if that doesn't stick in your craw a little bit, $15,000 letter writing campaign by the insurance industry to push the Secure Act because they really want access to your money. Oh, we need all of this because people just don't understand their retirement options. No, they're not saving enough for retirement, so they need more. They need more stuff, more options, more things, more ways to order on Amazon. You can post on Facebook, but you can't figure out how to save for retirement? Really? Anyway. The latest. I got distracted. I'm going to get distracted again if I don't watch it here. I got the latest on the Secure Act itself. It passed the House by an overwhelming vote, like 471-3. I mean, it was an overwhelming number. Stalled. This past week, we had a budget agreement that I don't want to sidetrack on this issue, but sadly raised the amount of money that the U.S. government can borrow. The U.S. government's basically just going to keep borrowing. Pity our kids and grandkids, but hey, that's a different conversation. The act wound up getting stalled because the deal that was cut said, hey, we're not going to add anything else to this budget deal that we have worked out. And so consequently, the Secure Act appears to be a little bit stalled as a result of the specifics of the budget agreement that was reached this past Monday. Never fear, though, the insurance lobby has come out and said, we are going to do double time to try and get it passed because, boy, this is very important to us to be able to introduce annuities more to the investing public because, after all, there's just no worse, highest commission product out there than that. Oh, sorry, that's not part of their lobbying speech. But anyway, that's between you and me. We'll keep it between us. Anyway, we'll shift some gears. Let's talk about the risk to retirement. So most people think that one of the biggest risks to retirement is a down market or a recession that then fundamentally reduces down the value of your assets. And that is fair. That's certainly one of the things that I think the vast majority of investors do, in fact, worry about. Perhaps they probably worry about that way too much because that skews your perspective on what really are the risks that are always present no matter what. Good times, bad times, up markets, down markets. There are some risks to your retirement that are always there. And one of the chief among them is sort of missing the point in terms of what your ultimate time horizon really is. And we see this an awful lot with folks that say, oh, I'm retiring, and that means that because I'm 65 or I'm 70 and I'm retiring, then that means that my investment allocation has to change to be more conservative, to have a much higher portion on the bond side. Remember, the bond side generally has a lot less volatility than the stock side. However, the bond side also has a much lower rate of return. And if you missed the first segment of the program, you know that those returns are not very good at all. And for $13 trillion of government debt out there, it's actually a negative number, which means you're literally losing money when you own those bonds. The miss of that is thinking that, okay, at this age, then because I'm retired, then it has to shift to that. That misses the more important notion of exactly what your time horizon is. Look, for the married couple that is age 65 today, one of you, the odds are nearly 100% that one of you will make it until 85. So when you start to look at it from a time perspective rather than just an age perspective, that is a 20-year time period. And the reality is that then that's what you need to be thinking about when it comes to your investments rather than, oh, I'm 65 or I'm 70. Now I must have a 40 or 50 or 60% bond allocation because that's what everybody has always told me to have. That's what you don't want to do. That is a significant risk to your retirement because what that means is that you could very easily wind up with a lot less money, particularly when you're older, because your assets have not generated enough of a return over the course of that time that you still have. So remember, that's a risk that's always present. Misunderstanding age versus time. Yes, you're 65 or 70, but the reality is that you still have another 20 or 25 years to go. And so moving those assets, moving your investment allocation too heavy on the bond side can really undermine your return over that period of time. So watch that. That's a real risk to retirement that exists no matter what. We're going to slide to the break. When we come back from the break, we're going to give you the other risk to retirement that exists no matter what. And it's one of those things that you've got to be aware of from an investment perspective, from an allocation perspective. We'll be back after this here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning News Radio, 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. This is Joel Garris of Nelson Financial Planning. You're listening to News Radio 93.1 WFLA. Covered a lot of territory over the course of the program today. Of course, if you missed any part of it or want to hear me rant again, then you can simply check out our website, nelsonfinancialplanning.com. We'll post the show tomorrow on the website. Or it is, of course, available on your social media channel of choice, whether that be YouTube, Facebook, iTunes, whatever else. There's a bunch of them out there. We throw it all up on all of those different places. I think we even do it on iHeartRadio, which is, of course, they love because, you know, they're who owns the station. Anyway, we're talking about the risks to retirement last segment, and the primary, one of the biggest ones. And these are risks, folks, that exist no matter what. So I think far too often everybody gets hung up on the risks to retirement that happen from time to time, tough economic periods of time, market declines. I think 100% of investors always fixate and focus on those, and they sort of lose track of the risks that are always there, no matter what. Chief among them is a misunderstanding age versus time. People think, oh, I get to a certain age, 65, 70, I got to change my investment allocation. They sort of forget about the time in front of them, which is, in fact, for the average American, a 20 or 25-year period of time. So you don't want to take your investment allocation and turn it upside down just because you hit a certain age. Be more mindful of the time that you have in front of you. Your assets, your investments, your retirement have got to continue to work and generate a return in order to generate income for that time period that you still have on this good earth. And people are living much, much longer. That is for sure. So don't mistake age for time. There's a big difference there. The other one that is always there is, of course, ignoring the impact of inflation. Inflation, very simply, is the rising cost of goods over time. The reality is that stuff's going to cost more down the road, whether it's a postage stamp or a gallon of milk or a gallon of gas. The reality is that that cost ultimately creeps up over time. How much? About 2 or 3% per year. So right there, that gives you sort of the bogey that you've got to make sure that your investments are at least doing, right? Because if you're not doing at least as well as inflation, well, that would be a pretty significant problem, because that means that ultimately the real value of your dollars is going down over time. That's a real risk to retirement. That's a real risk to your assets. So be aware. Everybody focuses on the risks that occur some of the time. Be more aware of those risks to your retirement that occur 100% of the time. Inflation's always there, and it's really about more the time that you have left rather than whatever hitting a particular age milestone. The time horizon that you have, the time that you have left, should dictate your investment allocation, not hitting an arbitrary age in the sand. Those are some real risks to retirement that exists no matter what. Hey, here's another risk. The potential cost that you're going to have to pay an attorney if you don't title things properly. Chief among them is assets that you wind up not specifying a beneficiary directly on. Client showed this invoice to me here this past week. The only thing that needed to go through probate was a house. That was it. The house was valued at $250,000, not a mansion by any stretch of the imagination, a normal house. The bill that the client showed me was $4,000 on a $250,000 house. That's a lot of money. How can you avoid that and not make the lawyers rich? Very simply, name people as beneficiaries on all of your accounts. This is a topic we talk about at length on this program. The reality is that we still continue to see that play out as an issue. You must do that. Look at your retirement accounts. Look at your insurance policies. Look at your assets that you own. Make sure that you have named beneficiaries on that. How do you do that? On a retirement account or a life insurance policy or similar to that, those types of assets allow you the immediate option to name beneficiaries as part of the application paperwork that you would see on those assets. As it relates to your checking account or savings account or what have you at your bank, those would simply be needed to have an additional registration called either a transfer on death or a payable on death that would name beneficiaries. And again, by doing this, you avoid those assets going through probate. No, it is not enough to have a will. A will, by its very nature, will go through probate. Most people don't understand that. They think a will avoids probate. A will does not avoid probate. A will takes you through probate and provides the roadmap during probate. Doesn't avoid probate at all. What does avoid probate is you name people as specific beneficiaries of the assets that you have. So whether it's that bank account where you've put a payable on death on, or whether it's an investment account that's not a pure retirement account like an IRA, that type of investment account, you would add a transfer on death, a TOD, a transfer on death. As it relates to hard assets like real estate, or maybe you own stock in a particular company or what have you, those you would want to title as a transfer on death as well. In the example of a house, maybe that's using a ladybird deed that would allow you to ultimately name beneficiaries directly on that deed. What happens then is when you pass, all of those assets pass directly to those beneficiaries through various paperwork forms, stuff like that. But more importantly, they do not roll through probate, because one of the things that you don't want to have to do is pay a big, giant bill to the lawyers just to process that paperwork that you could have very easily done while you were still living. So be aware of that. You certainly don't want to go through that. So double check that stuff this week, folks, and make sure that all of that is where it needs to be. Very simple to do. It just requires a little bit of time and effort to double check all of that stuff. Well, the music means we are going to wrap it up and get on out of here, and we will do that. But guess what? We will be back next week here on the program. This has been Dollars and Cents with your host, Joel Garris, Nelson Financial Planning, here on News Radio 93.1 WFLA.
This is Bud Hettinger. And you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.
Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit nelsonfinancialplanning.com or call us today at 407-629-6477 to set up a personal conversation to review your investment costs. That's nelsonfinancialplanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 93.1 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.